Want to buy a car in 3 years, planning a wedding or a vacation? Then you need short-term investments that are safe, liquid, and offer better returns than your savings account. In this video, we'll explore the 6 best short-term options for a 3-year goal and tell you exactly how much return you can expect, what the risks are, and which one suits you. Let's start with debt mutual funds. These invest in corporate bonds, treasury bills, and government securities. For a 3-year horizon, you can consider short-duration funds or corporate bond funds. Expected return, 6-7% annually. Risk, low to moderate. These are affected by interest rate movements. Taxation, short-term capital gains, STCG, if held less than 3 years, taxed as per your income slab. These are ideal if you're okay with some fluctuations in returns, but want better growth than FDs. Gilt Funds invest 100% in government securities. That means no credit risk. The government won't default. But here's the catch. They're sensitive to interest rate changes. If rates fall, NAV goes up. If rates rise, NAV falls. Expected return, 5.5 to 7%. Risk, moderate, due to interest rate fluctuations. Taxation, same as debt funds. These work best when interest rates are expected to go down. For conservative investors, gilt funds can be a safer way to earn more than an FD, if you time it right. Need access to your money anytime but still want it to grow? Go for liquid funds. They invest in short-term debt instruments like treasury bills and commercial papers, maturing within 91 days. Expected return, 4.56%. Risk, very low liquidity, high withdraw in T+1. Taxation, STCG applies for under 3 years. They're ideal for parking emergency funds or when you're unsure when exactly you'll need the money. Fixed deposits are old school but still reliable. You deposit a lump sum for a fixed tenure, say 3 years, and earn interest at a guaranteed rate. Expected return 6-7.5%, varies by bank NBFC, risk very low, insured up to RS5 lock per bank liquidity, low premature withdrawal penalty, taxation, interest is taxed as per your income slab. If you prioritize safety and predictability, FDs are a strong choice. But remember, inflation may eat into real returns. Don't have a lump sum to invest? RDs let you save monthly and grow your money over time. Expected return, 6-7% risk, very low tenure. Choose 1 to 3 years. Taxation, interest taxed as per slab, perfect for salaried people who want disciplined saving for short-term goals. Want a steady income every month? The Post Office Monthly Income Scheme gives you just that. You invest once and get monthly interest payouts for 5 years. Even though the maturity is longer, you can withdraw after 1 year with a penalty. Current interest rate 2025, 7.4%. Risk, very low government-backed taxation. Interest is taxable, ideal for retirees or anyone who wants guaranteed monthly income and very low risk. So which short-term investment is right for you? If you want safety and fixed returns, go for FDs, RDs, or post office schemes. If you're okay with a little risk for better returns, try debt or gilt mutual funds. And if you need quick access to cash, liquid funds are your best friend. Hit like if you found this useful, share it with someone planning their finances, and subscribe to MoneyMindz for smart money videos every week.